Hello, everyone, and thank you for tuning in today. If you're watching this video, then I've most likely shared some details with you about this phenomenal product that we offer here at CMG Home Lending called the All-in-One Loan. Today, we're going to take a deeper dive into what this loan is. A little bit about myself. I've been in the mortgage business for 20 years and recently joined CMG after 11 years with my former employer. And I'll tell you that one of the major reasons I moved companies was that I was introduced to this product through some friends who had actually used the all-in-one mortgage. And quite frankly, I was blown away by what it was, by what they were able to do with their current loans that they had and get them paid off within just a couple of years. And I wanted to really learn more about what that was, how I could offer that product to my customers and serve my customers better. For not necessarily for everyone, but for to have that option for my customers. So um, the all-in-one mortgage is really a change of thinking of what the traditional mortgage product is. And the purpose of this video is today is to kind of illustrate how to pay your mortgage down more quickly without dramatically changing your spending habits. So I wanted to bring in an expert on this product, lives and breathes the product, has been with the product since its inception many years ago. Dave Herbst, he's the vice president of the All-in-One product. Dave.
Ryan, good to be with you. I appreciate you doing this. I think this is one of the best ways to get out information these days, obviously. And I think honestly, education in the world of finance is lacking in the U.S., especially about innovative products that are consumer centric. Put the customer out front. It's a new idea, but I think this is probably the best way to get the information out. I'm glad to be with you.
Yes, sir. Well, I really appreciate you joining me. And I guess let's just dive in. Can you talk a little bit about the history of the product? Why did it come about? And
Yeah.
what is the all-in-one loan?
Yeah, so the all-in-one loan, much to the surprise of a lot of people that learn about it weekly, is not a new product. We've actually had the program out since 2005. So we're over 19 years of having it available now, and it's in the state of Texas, of course, it's a little bit newer for primary residences specifically, not newer for investment properties or second homes. And we can touch on, the differences here in just a few moments, but I would say in your state, specifically, it's probably a little bit newer idea, but really to the nation, it's not. Although it's not a mainstream product, it's not something that is marketed routinely or easy to maybe market and promote in just a 10-minute or I'm sorry, 10-second or 15-second splash on social media. It's engineered differently. We started engineering this loan back in 2002, so the journey really dates back to then. And the idea behind the loan is to ultimately engineer something that helps strengthen the financial well-being of homeowners. We've all kind of grown up with the traditional products, and we're very familiar with the way they work. And those really lead to a high dependency on interest rates to offer value or savings, benefits or opportunities. And what we set forth to do was restructure that, really, change the way that money is applied and used inside the mortgage, so that it accelerates pay down, develops equity in real estate faster, saves people in interest cost and the total payments they have to make on their mortgage to get rid of the debt without relying on interest rates as much, and obviously without a disruption in their lifestyle or budget. That's what we set out to achieve. And it dates all the way back to the beginning, 2002. And we haven't stopped since. We put it to market in June of 2005 and continues to be a loan that we're proud of. It's part of our DNA, as you know, and it's not a small portion of our business either. It's as a company nationwide, it's about 10 to 15% of our total, mortgage production each and every single month. So it's an exciting loan program, and I've been at it with the company for 21 years now. So I have it myself, just in case you're wondering out there. I do have it myself. Most of us do, obviously, within the organization. It's one of those things, like I think you said earlier when we were talking offline, Brian, once you learn about it and understand it, and it's hard not to get excited, and it's hard to look away. You sort of, it's like the red pill. in the matrix. You can't go back, kind of thing. So it certainly helped my family out tremendously, and I can touch on that as well as we talk.
Yeah, absolutely, man. Well, so we've got traditionally you come in, you talk to you're going to buy a house and you're looking at you're basically getting specific options. You want a 30-year, you want a 15-year, 10-year, whatever it may be. Why would I want to look at an all-in-one mortgage? Let's say I'm going to buy an investment property. Why would I look at the all-in-one versus a 30-year fixed mortgage? Let's say.
Yeah. Ultimately, it really comes down to what a customer is wanting to achieve. We typically think fairly short-sighted when it comes to our mortgage decisions. Most of the market makes decisions based on what rates are doing and what that equates into a monthly payment obligation. And we're all used to that conversation. Of course, achieving the lowest interest rate possible is important because that helps manufacture a lower payment obligation. And of course, that makes life a bit more comfortable. But that's really not where it ends, right? There's other things that people want to achieve, and that's really where the all-in-one loan is different. It instead of just focusing or stopping at the payment discussion, the all-in-one loan is an opportunity to talk, more deeply about what somebody is ultimately trying to achieve, not just with their home, but just in terms of their personal finance. Retirement is something that working Americans are looking forward to and trying to achieve, right, securely. I would say that most people don't want to overpay for things, especially a mortgage and their home. If you can reduce the price, the total cost of a house that you're financing or needing to borrow money for, that would be a good thing. I would say that's an outcome that is important. I would also say that people would like to achieve payments that reduce and pay, and so they pay less each and every single month. I would also say that people would like to develop equity in their property much more aggressively. What if you didn't have to just wait for your home to appreciate? What if you could actually develop equity more aggressively because your principal balance falls faster? That's also part of the equation here, and the all-in-one loan is engineered to do that. And I would also say people want to be liquid. I think we can all agree that having more money and resources available for sometimes the planned expenses and sometimes the unplanned expenses that come your way that we're challenged with. Having resources readily available to be able to fund those things and get through those times securely, I think is another outcome that is important to people. And certainly that's the all-in-one loan is engineered to do all those things. So, to answer your question, to summarize, where we tend to fall short of a complete conversation that encompasses what we're actually trying, what the actual objective is, the all-in-one loan takes over. And that's compel people to really think about that. You get a loan, you ask what the payment's going to be, what's the lowest rate and cost I can get, and what my payment obligation is going to be. It's all important. But if we can go further and say, look, what do you want your principal balance to be in 36 months? How much equity do you want to have in your home? Would it matter to you to have access to those dollars 24/7 without having to refinance from this point forward? Would it matter to you to pay off your home maybe 20 years earlier than that other traditional mortgage would have you paid off? Because maybe retirement's something that you're really shooting for securely, and it's hard to achieve if you still owe a mortgage. These are matters of importance, and they're worth discussing. I think the difference here, though, the challenge is that a lot of people don't realize how much money a mortgage actually consumes and how changing the way a mortgage works can actually help solve those things.
All great information, Dave. So, can you just tell us a little bit about how the all-in-one loan works in a bird's eye view?
Yeah. So we brand name it the all-in-one loan because what we've done is we've consolidated the mortgage, and I can cover the terms of the mortgage security in just a moment, and they're important. We consolidated the mortgage with personal banking. Let me repeat that. Home financing and personal banking wrapped up into one financial tool. And this makes a lot of sense. It makes a lot of sense. Mortgage debt statistically consumes the most amount of money, income, valuable income dollars than any other debt that we service, in any American household. Conversely, a checking account, bank accounts are obviously used as a place to store income and pay our bills from. But what a lot of people don't realize is the volume of money that they flow and manage through their personal checking accounts. It's an extremely important financial product. checking accounts, an everyday checking account. The average American out there, especially those that own a home and owe a mortgage, will actually manage more money in just 5 years through their checking account. Deposits, spending in aggregate, a total volume of money that flows through that account is more than they owe on their mortgage, right? So
Well,
when you start there, when you kind of start with that idea, you go, gosh, I never thought about things like that. What if that money, when it's in the checking account, could be applied to the mortgage? What if that idle money that I don't need to spend right now, maybe I need to spend it tomorrow, or maybe this coming weekend, or maybe for my property taxes due in 2 months? What if you could utilize the money that you've earned, worked hard for, that you don't need to spend right this moment today? What if it could go to work? What if it go to work inside the mortgage? And that's what we created. That's the special part about integrating personal banking with home financing. It creates that opportunity, this relationship, beneficial relationship between dollars earned and dollars owed, because dollars owed cost us more dollars, right? The interest dollars. The idea behind the all-in-one loan is to make it easier for people to use money they've earned to avoid costs on dollars owed in the mortgage. And so the structure of the product is, there's two versions of it. One is specific to a Texas homestead property, a primary residence in Texas specifically. And then there's what we call our standard all-in-one loan, which is for everything else, whether it's in Texas or across the United States. In a Texas homestead all-in-one loan, the checking account is an FDIC insured, fully transactional checking account. Pay your bills from it, online banking, bill pay, supported by Visa, check writing. You can link external accounts, move money back and forth as you naturally would any other checking account. Fully transactional. Even pays an interest rate, just like any other checking account. The difference is it comes with your mortgage. And the mortgage side of the all-in-one loan is actually a line of credit. So first lien position, 30-year term line of credit. For the Texas homestead or primary residence version, it's a 25-year draw line of credit. So it gives people access to their money or equity money for full 25 years. If there's a balance owed after 25 years, whatever's owed at that very moment for the remaining 5 years is just amortized in 60 equal payments. But think about this. A checking account and a mortgage, a line of credit tied together, now gives an opportunity to a customer to move any idle money they have in their checking account directly to their loan that day that money is earned. So the loan balance reduces. This is the only loan in America that pays principal first over the term of the product. So imagine you get paid $10,000 today, just to use a big round number, and you make that deposit. It could be a direct payroll deposit directly into your all-in-one loan checking account. And then you maybe set it up already. Maybe you already have an automatic transfer to your mortgage, all-in-one loan mortgage, which is the line of credit. So that $10,000 moves or transfers into the mortgage that same day, and your balance drops by $10,000 on your mortgage. Now, here's where that creates a benefit. The interest on this loan is not amortized. It's not predetermined like a traditional loan is. We all know how it works. Traditional loans come with a predetermined amount of interest that's built into your payments, and a lot of that's paid for up front. Not the case with the all-in-one loan. You make that deposit, transfer those funds, your balance reduces by that same amount. So 100% principal paid down first. Then it's going to recast interest nightly. The only loan in America that actually recast interest at the end of the day on whatever balance is outstanding. And because it's a line of credit, Brian, it keeps that money liquid. So if you need to pay a bill the next day, you just pull out the money, you pay a bill. But that money is at work. It's effectively saving more interest, more mortgage interest while it's in the mortgage than you could possibly earn by storing that cash in a traditional checking account.
So if we're talking about like a different way of thinking about the mortgage, traditional mortgage, and different way of thinking about your checking account as well, right? I mean, right now, the money that's in your checking account, what are we making on that? Cents,
Yeah, near zero. I think it's 0.07 or so is the national average today.
Right. And once you pay your mortgage payment, that money's gone, right? There's
Right.
no access to that money anymore. This
Bingo.
is a totally different way to look at it.
Yeah.
And it's just, I just haven't heard anything like that before.
Yeah. Imagine we can all relate to it. Something happens that is unexpected. Maybe the hot water heater breaks or the roof needs to be repaired, or God forbid, there's a some sort of medical emergency you have to pay for out of pocket, whatever. Or maybe there's an opportunity that you'd like to capitalize on, right? Maybe it's maybe it's time to renovate the kitchen, or bathroom needs to be redone, whatever it may be, being liquid with those funds. So, what I like to tell people is, what if you had access to the money you paid towards your mortgage? What if the last 12 months worth of payments you could grab in and pull out of the mortgage at any time, right? Versus having to go to your 401k account and take a hardship loan, or to, liquidate some investment, or to, use your cash savings that's really for a rainy day, really catastrophic stuff. Don't touch that. What if you didn't have to? What if you could just reach back in and use your payment money right back out of your loan, right? Because you were liquid 24/7 over the entire term, the draw term of the product. 25 years for Texas Homestead. It's 30 years for a standard all-in-one loan, which applies to investment properties and second homes in Texas and primary residences in other states outside of Texas. But I think that's a key part of it. You're dead on. It's the liquidity side of it, having access to money, greater security blanket for people financially, but also greater control of the cost that they're being charged on the money they owe. And I don't think anybody wants to overpay for things. I don't think anybody wants to pay more than they have to for things. And this is an opportunity to pay less.
Yeah. And we talk a little bit about the gentleman that I was talking to just this morning about, the loan that he paid off within a couple of years. One thing he said was, able to kind of see what exactly is going on with his interest daily, and was, just more motivated than ever to utilize his money in different ways to be able to pay his mortgage down more. We talked about the variable rate that's associated with it and how that works. And even he mentioned, like, compared to like a traditional mortgage, just looking at, it's just phenomenal the way that even if the rate is higher, because of the way the money is being utilized, you're saving so much interest over time. Can you speak about a little bit to that?
Yeah, totally.
Yeah.
Yeah, I don't think, again, back to one of my original points, I think that financial literacy just isn't something that's taught. It takes, sort of self-education. You really kind of have to, seek out videos like this one to kind of learn, I think, more and more about the way money works and interest rates move, and interest rate structures, and why this, why that. I think we all have been, brought up to believe that fixing in an interest rate on your mortgage, thereby fixing in your payment, is the safest way to manage debt. And it's not. It actually adds risk, because think about it. Your life, nothing else in your life is fixed. The cost of living isn't fixed. Your grocery bill is probably higher today than it was just 36 months ago. Car insurance, home insurance, you name it. Everything around us moves in cost that we have to pay for, and it goes up pretty predictably. Sometimes it goes up faster, right? Inflationary environments, and it takes a while for wages, our income, to sort of catch up. So while the cost of living is variable, a fixed rate payment structure, an amortized traditional loan where it fixes in the payment, tends to squeeze people's discretionary money, right? So if your cost of living has gone up, but your payment's the same, it hasn't come down. Maybe you've been in your loan for 3 or 4 years, but your payment's the same as it was day one. Well, what if you got a loan that actually where the payment came down, right? This is the benefit of the rate structure and the interest computation, or the calculation. The way we approach it is that let's allow people to reduce their daily balance aggressively with money they already have in their possession, they've earned, right? And they have it in their hands. Use that to reduce the daily principal. Let's recompute interest rates on the new daily principal each day, right? So we can help people manufacture a lower interest payment each and every single month, as aggressively as they want to. The goal is zero. We all want a 0% mortgage. That's better than a 3 or a 4 or 8% mortgage, of course. Zero is the end game. That's the goal in mind. So why not help people just get to zero sooner in their life, right? And do it automatically, naturally, and safely. That's the beauty of putting the checking account together. The interest rate on the all-in-one loan is variable, like you said. Now that's by design, because we don't want to fix the cost. Fixed rates fix costs, right? And that's the issue. What we're doing is we're saying, you reduce the cost. You get the opportunity to take control. And so the interest rate is tied to an index that's very predictable, and a margin that is fixed. That portion of the rate is fixed. The index is an index that is broadly used in the US, and that can move on the first of each new month. And it's moving downward today. And it tends to follow monetary policy in the US. So it's very predictable. Together, the margin and the index equal the interest rate being, computed on the loan balance each day to create a payment at the end of the month, the interest payment. And so, the interest rate's not just predictable, it's also very competitive to traditional loan interest rates. But here's the beauty. The beauty is that the balance is reducing more aggressively, which offsets the impact of being charged an interest rate altogether. So that's how that works. And what it does, it's a healthy way to really keep our borrowing costs as a lender aligned with what we're yielding in interest off of a loan. Loans are assets. It's an interest bearing. That's the reason why lenders are lenders as a business model, right? So lending money out and gaining some interest income off that is the business. No secret there. The difference here is that we are creating a stickier, safer way to manage that cost and help people reduce it and strengthening their financial well-being, all out of one packaged product in the all-in-one loan.
What would you say to someone that says, "Well, I've got a 6% interest rate, and I'll just pay additional towards my principal every month"? What's the differentiation there?
I love the question because it tells me that somebody's on track, right? They understand that that reducing what you owe can save you time and interest cost. The big difference is that prepaying an extra money towards a traditional loan locks that money up permanently in what I call mortgage prison. Can't get that money back. This is behaviorally, and I don't challenge people with what they want to do or their rationale or their logic. I don't pretend to know what somebody's willing to do. Some people are willing to do that consistently. But I can tell you less than 4% of American homeowners prepay their mortgage at all, and they do it infrequently, and they do it with a very little amount of money. That's the problem. And for good reason. That money's unsafely locked away in that mortgage. You can't get it back. And the other problem is that people don't use their entire paycheck, right? Or a big portion of their paycheck. They only use a very small portion of their paycheck to add extra towards principal. That's completely solved with an all-in-one loan because it's a 25-year draw in the case of a homestead version of the product for primary residences in Texas, and a 30-year draw line of credit. Keeps that money liquid 24/7. So you can make a deposit today, get that money into your line of credit, your mortgage, pay down the principal. Tomorrow, pull that money right back out. Or the very next moment, you're liquid. That liquidity is key. It's secured access to money at all times, but why you don't need it, put it to work. And the person that has a 6% mortgage that wants to prepay, I would also say, 6% repaid over 30 years, or even 25 years or 20 years with a little extra payment towards principal. That's still going to cost that borrower about 100% interest relative to what they borrowed. So borrow 100 grand, repay it over 20 to 30 years, you're going to pay an equal amount or more in interest cost, right? Mm-hmm. And that's not, when you really kind of break it down, I'm borrowing 100 grand, why am I paying you back 200,000? Wouldn't it be better if I borrowed 100 grand and only had to pay you back 30,000? Right? So reducing the cost of funds, the cost of owing money is really not exclusively, but really predominantly as a result of what you owe and how long you're going to owe that money. It's less about the interest rate, It's more about principal.
Yeah, one of the interesting facts that it's known, but I don't think people really consider. But what is it, like 50% of your interest of you pay
payments
for the first 10 years of your loan is primarily all interest, right?
Anywhere from about 50 to about 90% of your payment money is consumed by interest costs in the first decade alone with a traditional amortizing mortgage, right? And so I just challenge people, think about the consumption of all that money that you have worked hard for that, in this payment plan is not even going towards reducing what you owe. That's a large portion of your payment money and your income dollars that is going to just interest cost, It's great that we're afforded the opportunity to have access to credit. I'm not discounting that whatsoever. But it's sort of this necessary evil. Most people in America need to borrow in order to really build up a standard of living that they want and that they like, mortgages included. But helping people just reduce that debt, I think, is a very healthy thing.
And you don't this doesn't have to be your primary checking account, correct? It can be a separate account.
Yeah.
The other cool thing is, like, it's not like this money isn't yours. It's all, the deposits that you're making are going in towards your bringing your mortgage balance down. But as the month goes on, you need money for this or that. It's just like a regular checking account. You have a debit card, checks. There's nothing changed except that it's all going in and recomputing nightly that interest,
That's
and
right.
it makes a hell of a difference.
That's right. The faster you get money, and it's the same transactional. It's a real bank account. This isn't fintech, right? Just in
Yeah.
case somebody's curious, this isn't a line of credit with something that gives you some access to it that looks like a bank account, but it's not. This is a true checking account. It's serviced by our bank partner, and it's a fully transactional, secured, FDIC insured, fraud protected checking account. And that's it. The checking account portion of it, though, is sort of the conduit to get money in easily and out easily of your mortgage, which is a line of credit. It keeps that money available for use. That's the whole point of the checking account. Let's use it as a pass-through engine to get money to a place that's more meaningful, right? To avoid cost. But then you have full access to money. So ATM, debit, Visa cards, online banking, mobile app, customer service support, that can help set up, external accounts and transfer money. You can wire money anywhere, ACH money between other bank accounts, set up online bill pay, automatic, set that stuff up automatic to pay all your bills. It's sort of set it and forget it. Get the money into your mortgage, save money and time on that debt, but pay your bills like normal and live like normal.
Yeah. Well, Dave, man, I tell you what, I couldn't be happier with having the availability to be able to offer this product to my clients. So glad that you were able to join us today. And I'll tell you guys what, if you want to learn more about the all-in-one and how it may work in your scenario, please feel free to reach out to me. We obviously do all types of loans, and this is just another option for you. But I would love to chat with you about what your financial goals are and see if the all-in-one product might be good for you. So, Dave, thank you again.
Yeah, my pleasure, Brian. Thank you.